Welcome to this explanation of fixed-rate mortgage options. While almost everyone knows of the 30-year fixed mortgage, few consumers are aware of the many options available. First, understand that fixed rate is the opposite of adjustable rate and amortized is the opposite of interest only. Many people get those confused. A very popular loan on the market today is a 30-year fixed interest-only mortgage. It's a true fixed rate, but for the first 5, 10, or 15 years you're allowed, but not required, to pay interest only if you so choose. Whatever balance remains at the end of that 5, 10, or 15 years will be amortized over the remaining term at the same fixed rate. If you choose to make the minimum payment over the interest-only portion, your payments will increase when you start paying down principal. However, you are likely to be banking more money in 5, 10, or 15 years anyway. People who want the security of a fixed-rate mortgage but the low affordable payments of interest-only financing usually benefit from this program. A full description of interest-only financing will be available at the end of this presentation. Note that a lot of mortgage advertising says fixed, which is sometimes only half true. Many hybrid ARMs are fixed for 3, 5, or 7 years and adjustable thereafter. The less time the bank has to commit to a given interest rate, the lower that rate is going to be. And this affects both the rate over the fixed term and the lock period. Every time you lock a rate, the bank is only committing to honor that rate for a certain amount of time, after which the rate expires and you would be subject to worst-case pricing. There's less guesswork over shorter periods of time. One option available on all loans is whether to pay points. Nobody ever wants any closing costs, but before you decide it's not for you, let's look at the benefits of why someone would choose to pay points. This is sometimes called a buy-down. In the case of a fixed-rate mortgage or hybrid ARM, this can be a means to get you a lower interest rate. And whether you should do this depends entirely on how long you keep the loan. In the case of short-term adjustables or pay option ARMs, paying points is a means to buy out a commitment period or buy down the margin. Here's an example. Assume you're getting a 30-year fixed interest-only mortgage and you intend to keep it forever by renting it out after you leave. If you get a no-cost, no-points loan, your rate might be 6.375. If you pay 1 point, no fees, you might qualify for 6% even. If you pay 3 points or 3% of the first loan amount, you might get 5.75%. Notice how the payments drop as the buy-down goes up. Assuming a $400,000 loan, payments are $2,125, $2,000, and $1,916 respectively. Your time to recoup is exactly 32 months and 57.4 months for options B and C. If you pay points and sell next month, that's a losing decision. If you hold for 32 or 57 months, you break even. Over the term of the loan, paying points would save you $41,946 or $69,524 based on the amortized schedules. Worth a brief mention are temporary buy-downs such as 3-2-1s and GPMs or graduated payment mortgages. These allow you to pay a lower rate as you get adjusted to the payment or pay off other debts. Neither are practical at this time, but will come back in fashion as the rates increase. I mention them to assure you that while rates are still near historical lows, banks will always work to innovate and make financing attractive. It is a business like any other, and they need to invent products that consumers want. I'd like to mention a brief note on bi-weekly programs. We strongly feel they are not worth the value because you can get the same effect for free. Lenders, or worse, third-party companies take money for something you can easily do yourself. Remember, with interest-only loans, you're paying on the outstanding balance, and additional money you add to your payments makes your future payments go down. With amortized loan, additional money you send makes your term go down, turning that 30-year loan into a 29-year loan. If you want the effects of a bi-weekly program for free, just add 1/12 of your loan payment to each check that you mail in or have taken out electronically. Doing so turns a 30-year loan into a 22.5-year loan. That said, before you commit to that, there are some very compelling reasons to not ever pay your house off, which is counterintuitive to traditional judgment, but the numbers and evidence are very strong. Click Leverage and Liquidity at the end of this for more information on this topic. Last, be aware you can choose from fixed rates up to 40 years, allowing you more freedom and payment flexibility if needed. Also, some loans are amortized over a longer schedule than the term of the loan. For example, a common fixed rate second mortgage is a 30-15, which is amortized over 30 years but due in full in 15 years. This allows you the payment of a 30-year mortgage at a 15-year rate. Other balloon notes are 30-20s or 37s or even 35s. Balloon payments should be planned for far in advance because you will be required to refinance, sell, or extend the note with the lender. A balloon payment that is not paid will result in foreclosure, but you'll have plenty of advance notice. The reality and statistics show that most people don't keep their mortgages. The average shelf life of a loan is 3 to 4 years, though in a rising interest rate economy this is likely to ease back a bit as people instead get second and third mortgages rather than refinance their first at a higher rate. When you're ready for more information or to make a change in your real estate needs, please contact our team.